What is a debt to income ratio, and why is it so important to a lender when determining giving you a mortgage loan? This is Diane Bullock with RE/MAX Executive, and I'm here to answer that question for you today. So follow me in this video, because if you're looking to buy a home this year and you've already started the process and you've heard that term, debt to income ratio, you need to know why it's so important and how it's going to affect your ability to get a mortgage loan from your lender. Let's dive in. In my last video, I gave you a complete 10-step guide to getting qualified to purchase a home. One of the steps that was in that process is getting qualified with a mortgage lender and allowing the mortgage lender to pull your credit, know your financials, and to do what's called a debt to income ratio. The debt to income ratio is usually determined by the lender what number they will accept. Most lenders will accept about 45%, and some of them will go higher than that. It depends on the type of loan that you will get, be it an FHA loan, a USDA loan, a conventional loan, VA loan, or some of the sorts. Anyway, the debt to income is where they take the actual amount of monthly income that you have and they divide it by the percentage that they require to see how much of your income is going out to pay for all of your debt, meaning your car payment, meaning your student loans, meaning your credit card debt and things like that. This is not talking about your expenses for food and gas for your car or miscellaneous things like that, your utilities or anything like that. This includes all of your revolving credit, things that will affect your credit score. So, like I said, most lenders will require about 45% of your income to go out to pay for your debt. Let me show you how this works. Explaining the debt to income ratio, as I mentioned before, most lenders will require about 45% of your income to be spent in your expenses, meaning your revolving credit, the things that you pay for monthly. You cannot go over 45% of your monthly income to cover these expenses, meaning your revolving credit, like your car payment, like your student loan debt, like your credit cards, and anything that affects your credit score, okay? So in this example, let's say the lender requires that you cannot have more than 45% of your monthly income being paid into your debt. So if you make $45,000 a year, okay, the lender's going to take the 12 months of the year and divide the $45,000 into those 12 months, and it'll give you a monthly income of $3,750, okay? Your annual income could be $45,000. You're dividing that by the 12 months of the year, and it gives you $3,750 for the month. Because they will not allow you to go over, let's say, your 45%, which is your debt to income ratio, they're not going to allow you to pay more than 45% of this monthly income into your debt. You take the 45% of the monthly income, which is the $3,750. If you take 45% of that, it leaves you with $1,687.50. Okay, so this is what your monthly allotment is to spend on that debt. Okay, so your total income would be $3,750, but 45% of that is $1,687.50. Okay, you cannot go over this $1,687.50 in paying your debts or your expenses, because that will increase your debt amount, and it will affect the amount of money that a lender will give you in a mortgage loan. Okay, so if you go over the number and it's what they require, for example, if they require 45%, and most of the time with FHA, that's what they require, the lenders require. But if you go over the 45%, they may not give you the mortgage loan until you pay off some of that debt and your monthly income allows you to stay within this range, okay? Sometimes they'll give you, the lenders will allow you a little bit higher in a debt to income ratio, meaning they'll allow up to 50%. But that is determined by the type of loan that they're going to offer to you, be it an FHA loan, be it a conventional loan, a VA loan, a USDA loan, any types of these loans. The lender determines what their actual ratio is going to be. But this is an example to just give you a visual of how that would work, okay? To further explain that example, let's say from the income that you had, which is the $1,687.50, let's configure in the debt that you actually pay. We're not talking about miscellaneous expenses. Remember, this is not including your clothing expense, your food expense, your gas for your car, your utilities. It's not including anything like that. This is just including the monthly payments that you make to your revolving credit. This is credit that affects your actual credit score, okay? It does not mean like if you pay over an amount. Let's say for your credit card, your minimum monthly payment is about $200 and you've just been paying $250 just to get it paid off quicker. It's not talking about the $50 over. It's your minimum monthly payment, which is the $200. So in this example, if you have a car payment of $200 per month, and then you have a credit card payment of $150 a month, and a student loan payment of $150 a month, that's going to leave your debt to be paid for that month $500. I know that this figure is probably low, but I'm just giving you a visual. So for your monthly expenses, you have $500, and let's say you want to get a mortgage payment that is not going to be more than $1,200 a month, because you've looked at some places, you kind of know where the ballpark figure is in that area, and you kind of know where you want to stay. So let's configure in your $1,200 a month mortgage payment. So when you take that $1,200 monthly mortgage payment and you add your $500 debt payments that you already have, that's going to give you $1,700 a month going into your expenses. So this is going to put you over your 45%, because remember the 45% is $1,687.50. So what a lender may do is say to you, well, because you are over the required limit for us, they may ask you to pay off some of your credit card debt a little lower, just so that you could qualify and be under that 45% debt payment ratio that they require, okay? So I hope this part helps. So as I've just explained, the debt to income ratio is actually a figure that is determined by the lender based off of the loan product that they're going to give to you, meaning your loan type, your FHA, your VA, your USDA, your conventional loan type. The lender will determine the debt limit that they will accept and determine how much of your income is going towards that debt to determine how much they are willing to give you in a mortgage loan. The breakdown that I just gave was just an example to show you that what a lender will do is take your annual income, they will divide it by 12 months to get your gross monthly amount, and then they will take a percentage of that. Most lenders will use 45%, meaning you cannot go 45%. You cannot go over 45% of your income to be spent in the debt. So if you have outstanding debts and you know what your mortgage figure is that you want to pay in your monthly mortgage payment, and you add those together and you look at that 45% of your gross monthly income and know that you cannot go over 45% of that amount, then you'll know that you're in good standing if your spending is well below that amount. Okay, so again, this is Diane Bullock with RE/MAX Executive. I hope this was helpful to you. If you have any questions, please reach out and subscribe to the channel, like the channel, look for more information, and just ask your questions in the comment section, and I'll be happy to get back to you with a response. And as I always say, let's just make it a good day. Bye.